Money. I mean, how much is a lot of money to you?
Yeah, that's a good question. Have you made, say, millions of dollars?
Consider the most fundamental question in finance, not what money is worth, but what money actually is. Most people believe money is the cash in their wallet, the balance in their checking account, or the number on their paycheck. They see it as a medium of exchange, a unit of account, a store of value. This is true, but it is also the most superficial understanding possible. To the powerful institutions that shape the global economy, the private equity firms, the family offices, the sovereign wealth funds, the central banks, money is not a thing at all. Money is a claim. It is a legal and social contract representing a claim on future value. And the most important claim of all is not on cash, but on the assets that generate cash. This is the primary distinction that separates the financial reality of the average person from that of the wealthy elite. You do not understand money until you understand ownership. The average person's financial life is dominated by the flow of income. They work, they are paid a wage or a salary, they pay taxes, they pay bills, and if they are prudent, they save a portion. Their financial existence is linear, a path defined by the next paycheck. They are laborers in the flow. In contrast, the wealthy person or institution focuses not on the flow, but on the stock. They focus on the capital asset itself. The business, the real estate portfolio, the intellectual property, the entire revenue-generating machine. A doctor earning a salary of $400,000 a year is, by standard metrics, highly successful. Yet their wealth is contingent on their continued physical and mental capacity to show up and trade their time for money. A family that owns a small chain of laundromats, generating a net cash flow of $100,000 a year, owns an asset. That asset, if valued at a standard commercial multiple of 4 times its earnings, is worth $400,000. If the doctor and the laundromat owner both have a savings rate of 20%, the doctor is saving $80,000 a year in cash. The laundromat owner is saving $20,000 a year in cash, but the value of their asset is also growing in 2 ways: through the reinvestment of retained earnings and through the appreciation of the asset itself as the market values its cash flow more highly. If both assets return 10% per year, the doctor's savings grow, but they are still just cash. The laundromat owner's asset not only grows in value, but it also continues to distribute cash, creating a self-sustaining cycle. The doctor's wealth is a function of their own labor. The owner's wealth is a function of a machine that works on their behalf. This reframes the entire concept of assets. In personal finance, an asset is often defined as anything you own that has value. But this is a weak definition. In the world of corporate finance and institutional investing, an asset is a system of cash flow. A share of Apple stock is not a piece of a company's physical property. It is a legal claim on the future cash flows of Apple, distributed as dividends or reinvested to grow the company's value. Similarly, a rental property is not a physical building. It is a financial instrument generating monthly rent, with an embedded option for its value to appreciate over time. The wealthy understand that the goal is not simply to own assets, but to own a portfolio of assets that generate more cash flow than the cost of the liabilities used to acquire them. This leads to a critical distinction: the difference between consumption and investment. Buying a luxury car is often framed as buying an asset, but if that car does not produce income and its value is depreciating rapidly, it is a liability disguised as an asset. It's a sunk cost of consumption. The wealthy person buys assets that produce income or appreciate in value, and then they use the income to buy their toys. The car, the house, the art, they are all paid for by the machine, not by the labor of the owner. This leads us to the weaponization of debt, a concept that is entirely misunderstood by the average consumer. For an ordinary person, debt is a burden. It is a mortgage, a student loan, a credit card balance. It is a monthly payment that erodes their capacity to save and invest. For the wealthy and for institutions, debt is not a burden. It is a fuel. It is leverage. In finance, leverage is the use of borrowed capital to increase the potential return of an investment. It allows you to control a large asset with a small amount of your own money, magnifying both gains and, of course, losses. This mechanism is the engine of the modern financial system. When a private equity firm buys a company for $1 billion, they do not use $1 billion of their own money. They might contribute $200 million of equity from their fund and borrow the remaining $800 million from a consortium of banks. This is the acquisition debt. If they can improve the company's operations and increase its cash flow, its value might rise to $1.5 billion in 5 years. When they sell it, they repay the $800 million, and the remaining $700 million is profit on their original $200 million investment, a return of 350%. It is the use of debt that transforms a good return into a spectacular one. The wealthy person treats debt as an instrument to acquire assets at a faster rate, recognizing that inflation erodes the real value of fixed-rate debt over time, while the value of the asset it financed ideally appreciates. The ordinary person treats debt as a way to finance consumption, which is a losing proposition on both ends. The asset depreciates, and the debt persists. Now consider the legal and corporate structures that govern ownership, which are the architecture of this system. The corporation is arguably the most important invention in economic history. It is a legal entity that exists separate from its owners, which means it can enter into contracts, own assets, incur debt, pay taxes, and be sued all in its own name. This creates a powerful shield, the corporate veil. If a business fails, the owners do not lose more than their investment in the company. If an individual cannot pay a personal debt, they might file for bankruptcy and have their assets seized. But if a corporation cannot pay its debts, it can be restructured or liquidated, and the shareholders simply lose the value of their shares. Their personal assets are protected. This is the legal foundation for unlimited ownership. You can own 100 companies, each one protecting your personal wealth from the liabilities of the others. This is also why the wealthy do not merely hold cash, they structure it. Wealth is not a number in a bank account. It is a web of legal entities, trusts, partnerships, and holding companies designed to protect assets, optimize tax treatment, and ensure continuity. Taxation provides another perfect illustration of this principle. The tax code is not a mere tax on income. It is a reflection of social policy and a powerful tool of control. It incentivizes certain behaviors and penalizes others. The United States tax code, for instance, taxes income from a job, known as earned income, at a higher marginal rate than income from investments, known as capital gains. If you work and earn a salary, you pay income tax. If you own a stock and its value increases, you do not pay any tax until you sell it. And when you do sell it, you pay capital gains tax, which is typically much lower than the income tax rate. Furthermore, if you never sell the asset and instead borrow against its appreciated value, you can access the wealth to fund your lifestyle without triggering a taxable event at all. This is the buy, borrow, die strategy. Wealthy individuals and families use their portfolios of stocks, bonds, and real estate as collateral for low-interest loans. They use the loan proceeds to finance their expenditures, all while their assets continue to appreciate. The interest on the loan is paid from the cash flow of the assets, which is also taxed at favorable rates. When they eventually pass away, the cost basis of those assets is stepped up to their market value at the time of death, effectively eliminating the capital gains tax that would have been owed if they had sold during their lifetime. The income earner, meanwhile, is taxed on their wages at a high rate and then taxed again when they spend their after-tax dollars. This is the structural reality of ownership. It is not about evading taxes. It is about legally structuring one's financial life to align with the code's incentives, which are heavily tilted in favor of capital ownership over labor income. To see this dynamic in action, look at the collapse of a major company. When a large corporation like Lehman Brothers failed in 2008, it was not a failure of a business in the traditional sense. It was a failure of leverage and liquidity. Lehman had billions of dollars in assets, but it had also borrowed billions of dollars to buy them. When the value of those assets, particularly mortgage-backed securities, plummeted, the value of the assets fell below the value of the debt. The company was technically insolvent, but beyond the accounting, a panic set in. Lehman relied on short-term, overnight loans from other financial institutions to finance its operations. These are repo agreements. When the lenders lost confidence and refused to roll over these loans, Lehman could not meet its immediate cash obligations. It had assets, but it had no cash. It was like a billionaire whose portfolio is entirely in real estate and who can't pay their monthly bills. The company was forced to file for bankruptcy. The people who suffered most were the employees, who lost their jobs, and the common shareholders who lost their equity. But the bondholders and counterparties, the lenders, had a different experience. They had a senior claim on the assets. They received the proceeds from the liquidation of the company's assets before the shareholders got anything. The most senior creditors, like the clearing banks, got almost all of their money back. This revealed the hierarchy of claims. The employee and the shareholder are at the bottom, at the most risk. The secured creditor is at the top, protected by the ownership of collateral. This is the brutal, unforgiving logic of capital. It does not care about your salary, it cares about the priority of your claim on assets. This is also why family dynasties and inherited wealth persist so effectively. Wealthy families do not just leave money to their children, they leave institutions. A single family office is a private company that manages the financial affairs of a single family. It employs investment professionals, lawyers, and tax experts. Its sole purpose is to preserve and grow the family's wealth across generations. It makes investments, manages the family's real estate, pays the family's bills, handles tax planning, and coordinates philanthropic giving. It is a formidable financial institution. Consider the Koch family, whose wealth was built on a refining and chemical conglomerate. They did not simply pass down cash, they passed down a controlling stake in a massive enterprise with diversified operations and a complex legal structure. The family office ensures that the governance, the investment philosophy, and the family's control of the business survive the founder. It is a system for institutionalizing ownership. The children do not have to be financial geniuses, they are owners who hire the best minds to manage their capital. This is the opposite of the lottery winner who, without a system to manage their wealth, often ends up bankrupt. The system of ownership, including its governance structures, tax planning, and legal advisors, is what converts temporary wealth into permanent generational capital. Ultimately, the lesson is not about hoarding money, but about understanding financial engineering. Ownership is a legal and financial superpower that allows one to capture the productive capacity of society. It gives you priority in the distribution of wealth. It provides protection from liability. It offers tax advantages that are unavailable to wage earners. It allows you to use debt to accelerate your path to riches. It permits you to design an economic engine that generates returns irrespective of your own physical labor. The working poor, the middle class, and the upper middle class are participants in the economy as workers and consumers. They are the cash flow that feeds the machine. The ownership class builds, controls, and owns the machine. They own the companies, the real estate, the intellectual property, and the financial instruments that create the economic output. They are not necessarily smarter or harder working. They simply understand and apply the rules of the game. The modern financial world is structured in a way that rewards the ownership of productive assets over the performance of productive labor. This is not a secret cabal or a conspiracy. It is the design of our economic system, a complex tapestry of law, finance, and economics that has been woven over centuries. To understand money is to understand that the flow of cash from your job is merely a current in a vast ocean. And to truly possess that ocean, you must not paddle in it, you must own the boat. You must move from the perspective of a saver and earner to that of an owner and an allocator of capital. This is the fundamental, transformative realization. The rich do not think differently because they are rich. They are rich because they think about money as a system of ownership, and once you see that, you can never see money the same way again.